Welcome back to Morning Trade Live. Tomorrow is the big day. Let's dive into some of the numbers outside and more specific than just the polls. Ben Breitholtz is a data scientist at Arbor Data Science. Ben, always good to have you on the show here. So let's just start with kind of the most basic in terms of expectations. When you look through your data and the way you approach numbers, how do you approach the election? What are you looking at? What's most important? What's the starting point?
So what we want to do is kind of provide a benchmark or something to compare to these polls and betting markets. So you have betting markets that are showing, a 65% chance really of a Biden victory versus the polls that are, much more tilted towards Biden. You have this big discrepancy. So what we do is we go to a source in Google searches where we believe consumers, businesses are more honest, hopefully remove that shy bias to their kind of leaning politically. So what we do is we're looking at a series of different categories and topics, one being left-wing versus right-wing politics. How much is that being discussed on a state-by-state basis? Biden and Trump themselves, and then also Democrats and Republicans. And what's unique about this case here relative to 2016 is we have quite the leaning towards Biden, towards left-wing politics, and that's pretty much unanimous across the battleground states, which again goes with kind of the market thinking for the most part and pricing in the Biden victory, and does lean towards the polls, which it'll be interesting to see if the betting markets come through and are kind of the outlier and ultimately prove correct. That's not seemingly the case based on this data.
So now the data that you're looking at, how do you define these things? Are people actually searching political news? Is it that kind of what their preference is based on what they're searching? Is there still an inherent kind of subjectivity in tying search topics to what people then are going to do with their vote?
I mean, it certainly could be bias within anything these days. We know things are so polarized, but what we're using are topics that are all-encompassing. So it could be left-wing politics that could cover, the whole gamut of left-wing initiatives and discussions, be it green energy or universal health care and so on, versus the right-wing side of things. And then same thing for Democrat and Republican. So underneath all these topics and these categories are hundreds, if not more, different search categories, or not searches themselves, individual searches, that we can then use on a comparative basis against each other. And again, this instance versus 2016, whereas in 2016 we had a slight bias towards Republicans to the right side, this time around we have a stronger bias to the left side, to Democrats. So we'll see if that proves correct or not. Yes.
Interesting. Okay. So compared to what you guys saw using this technique, and in 2016, you're seeing something very different this time around.
Correct. Right. We're having more of this left-wing bias. Now, again, we'll see if that is something that's just more representative like the polls.
Okay.
But we'll see again how much that proves to be correct. But this real spread between polls and betting markets is a bit interesting, and of course has caused this heightened degree of uncertainty that we've seen with the elevated VIX. We've seen term premium, for example, at the long end of the curve really accelerate 40 basis points higher coming into the election. And so I think that as much as we have all this alternative data to say there is some leaning and maybe to go with the polls, there's still a high degree of uncertainty here, and a lot could happen, of course, over the next number of days. And unfortunately, things with a contested election could push, a week or plus into the future. Okay,
so now trying to figure out the role of this within markets gets into the idea of elevated VIX, the fact that we've got some tail hedges that seem to be mounting again a little bit. You've got another analysis you do of financial news television topics, which doesn't include us, Ben, but that's okay because we'd probably skew this in a way far away from the politics side. But based on words and frequency of those words used across cable TV, elections number one. I'm not surprised by that at all because it also is what gets all the viewers. But if you have investors, if this is a representation of the investing community, then to me, the fact that election is way elevated in terms of uncertainty, then it just, again, it seems like our baseline here going into tomorrow is that as long as there's an answer, whether it's blue or red, Trump or Biden, the answer itself, if it comes soon, should bring some of this uncertainty out. Is that fair, or is there also an implication now that because all the polls and odds makers are skewed towards Biden, that you actually need the Biden win for markets to be at peace?
No, I think you're right. I think a certainty here, one way or the other, the Trump would, of course, cause potentially brew some uncertainty. But if we do get the expected Biden victory, and we know sooner than later, I think that a lot of this uncertainty fades. If you look back historically to 1970, talking about 10-year term premium, it habitually does rise into periods like now an election, and then after an election, it typically releases on median about 20 basis points or so. Now, a lot of the rise in long end yields as of late has been due to this term premium, not due to a risk or an inflation premium, which has been scant and hard to find, even though break-evens have rallied thanks to liquidity improvements. It's been based in this term premium, which is usually a random beast, moves around a lot, it's pretty volatile. But in this case, it's a pretty good chance if we do get some of this certainty that term premium is going to release, and that could mean that the Treasury curve could indeed remain, Treasury yields could remain range bound to potentially lower in the weeks ahead. Now, a lot of investors have hedged previously up till about 2 weeks ago for more outsized moves. You look at swaption volatilities. We had investors expecting it's really a skew towards higher yields. If you look at plus 25, minus 25 basis point potential movements. That's now tempered over the past 2 weeks, kind of like you just said. Some of this volatility has been sucked out a little bit, but I think that ultimately, certainty will, reduce this uncertainty in the markets and get us back to focusing on what I think is really driving risk assets and safe assets right now, which is the actual fundamentals of the economy, some of this higher frequency data, like we like to look at, like search activity. I think that's more connected right now to the overall movements in financial markets than the election itself.
So, Ben, I just want to go into this chart again for a second. If we pull it up again, guys, real quick on the term premium. So you're looking at U.S. Treasury yields, and you're looking at the difference in the yield between the short and the long term. And the black line there is the median. What we're looking at from this chart is trading days from election, where they come together at zero over there to normalize this. And you're saying that post-election, usually that term premium drops, so then yields generally come down on the longer end. It seems like coming into the election, the standard, at least judging by the median here, has been to be fairly unchanged. This time around, we've got something different going on, where the yield was moving up quite a bit relative to a low base, but still moving up quite a bit coming into this. So, Ben, here's what I'm trying to figure out is, if Biden's so skewed in the polls, which he is right now, the betting odds have him at a 65% chance. I mean, if markets aren't already pricing that, in, then we kind of have to say they're pricing it in, don't we? I mean, like, it seems like it's so skewed that what else would they be pricing in? If that's the case, then how can we have that yield situation reversing? If yields are going up and Biden's getting priced in, if he actually wins, is it like a sell the news event, or is that actually going to then beget more selling of bonds?
Yeah, I think we've focused so much on this fiscal policy story, and in the end, the direction, I think you had a really good tweet to Oliver, showing that no matter what president we get, there's likely to be rampantly higher deficits and a decent degree of spending down the road.
Oh, yeah.
So I think, in the end, I think what it really comes back to is the actual economy here. And so we've had this election come up. And again, like you said, term premiums have risen due to uncertainty. Part of that uncertainty is we are now on the fence. So with this global recovery, it looks somewhat self-sustainable, but we have three key components now that are on the fence. We have just better than 50% of economies across the globe growing above their one-year averages, so that's on the fence. In terms of commodities, just recently we had 50% of the world's largest, of major commodities away from precious metals that had year-over-year gains. That's right on the fence. And then we have inflation expectations. If you look at the inflation swap caps and floors, looking at 10-year and 30-year outlooks, those are right near 50% probabilities of exceeding 2% year-over-year, the Fed's target. So you have the election, and then you have all this other stuff that's now on the fence. Do we get this really, get a really continued recovery that kind of moves into the bullish side of a lot of these numbers, and will hopefully then give rise to the long end of the yield curve? Or are we going to see a little bit of a stutter here with the rise in COVID-19 cases, some slowdowns in high frequency data, and that wouldn't necessarily be bode too well for the long end of the curve and really the steepening trend that we've seen?
Okay, so then there's a positioning aspect to this as well. Appreciate the tweet shout out, by the way. The joke there was that it's like a quadrant of who wins and what wave, and it's all the same basically. Everybody wants to spend. So positioning, you've got another chart here that looks at positioning right now. How does this relate to what's happening in treasuries at the moment? It seems like investors are preparing maybe now, or at least kind of getting to the other side of the boat that bonds could sell off. Is this a contrarian indicator? How do we interpret this?
Historically, it has been. So if you look at the large speculators on the long bond, at about negative 20% of open interest is where they're at in terms of actual number of contracts that they're short. So there's this huge near record short position, the most since May 2006, I believe. And historically, when we've seen this number in terms of percentage of open interest drop below negative 10%, yields have been sideways to higher in the weeks and months to follow. That hasn't necessarily happened that quickly this time around. And I think this time around is somewhat different. We have a heavy degree of volatility selling that's still going on within treasuries themselves, those expecting the Federal Reserve to continue to swoop in and dampen down volatility and really follow their fiscal stability mandate, which is, of course, their so-called third mandate. So I think that the short position here could end up being a hedge to that actual volatility selling more than an actual bet that yields are going to go just rampantly higher. And so I think that's kind of being, if you look also at the shorter end of the curve, 5 years, 10 years, you don't see the same degree of short bias, more or less priced in. And again, the hedging activity that we had seen across the curve building up to the election about 2 weeks ago was heavily skewing short. That's now started to release a bit too. So I think that it's not a sure thing that we get rampantly higher yields. It's going to be based on what the three metrics I just discussed. Economy is growing. We need commodities to continue to see year-over-year positive gains. And then we need, more importantly, we need inflation to pop up. And that's really been the missing link here for quite some time. And if you do a lot of these decompositions, there's more fancy academic models like the DKW, you find that there's no inflation premium that's really been put into treasury yields since COVID's hit. It's been mainly this liquidity premium, and that's helped essentially break evens widen and keep real yields low. So it's a lot of big question marks, I think, going beyond this week, beyond just the election. Okay, so it's definitely a pretty complex situation here where you've got yields climbing without inflation even being factored in. The election having this kind of weird role where the hedging through maybe even selling some of the treasuries is kind of the situation where in equity markets we see vol bid up as potential reflection of maybe hedging equities, but given the role of stimulus being attached particularly to the candidate who's in front right now, maybe the preparation there for bonds is to get a little bit short in those expectations. Ben, the last thing I want to make sure we hit on here is we were talking about it earlier in the show too. It seems like with all the election myopia right now that I don't hear a lot of conversation about the data. Our ISM just had a huge blowout number, 59. The last week, we saw for second week in a row, jobless claims getting back in line with expectations. Economic surprise index ticked up for the first time in 8 weeks. What role do you think that's playing here? And are we going to have to kind of catch up to that as the story? There's been so much election focus. I don't know. My personal view is that it's not getting appreciated, the data right now, and how solid it's been. What do you think? Yeah, I think that there is some of that. Again, the ISI number was a big surprise. It's good to see jobless claims continuing to fall. The scarier side, but not necessarily scary, just that things are seeming to slow on the alternative data side. So the higher frequency data that we're able to track, that can be search activity, it can be mobility. A lot of that data has stalled to weakened since the tail end or middle of September through current, and that fits pretty well with the drawdown that we've seen in the S&P 500. A lot of our search activity we track on the consumer side has retreated anywhere between 2 to 10% below baseline or where we'd expect it to be, which is kind of fitting with the equity market slowing. So I think the big question is, as we get away from this uncertainty of the actual election, are consumers' intentions, the search activity, are they going to go out and buy appliances? They're going to go out and buy more home improvement stuff? Are they going to apply for jobs and so on? Does that improve here and rebound, which this chart you're showing right now I think is a great representation of that, to then hopefully bolster and get the equity market back higher? Because I agree, I think a lot of the focus has gone to the election, which is important without a doubt, and we have the imprint in our mind from 2016 with this huge 75 basis point jump in 10-year yields following the election. That's extremely abnormal. Typically elections aren't that exciting for markets. So I think that's imprinted in all of our brains, and we'll just have to wait and see what consumers ultimately do with the aftermath of this election. Are they going to continue to pull back modestly like they are right now, which wouldn't bode well for the S&P over the next S&P 500 over the next number of weeks, or are they going to feel more assured, get this certainty, and this continues to be a self-sustaining recovery, as evidenced by the ISM numbers, improving jobless claims, and so on.
Okay, Ben, great stuff as always. Lots to pour over per usual. Really good stuff. Glad to have you back, Ben.
Thank you.
Thank you. Ben Breitholtz, data scientist at Arbor Data. When we get back, the Chart Master has some stock moves.